Welcome to Top Profit Investor, the authority channel for real global profit strategies. Today, our research team identifies the 3 specific sectors where Wall Street's largest allocators are quietly positioning capital for outsized profit in 2026. This is not speculation. It is what institutional signals and leading investment surveys are telling us right now. Sector 1: Digital Infrastructure and AI Build-out Enablers. The markets have moved beyond bets on software only. Today's data show that the physical infrastructure of AI, data centers, networks, and related real assets, is where profits are expanding. According to recent market research, capital expenditures by hyperscale technology firms on data center capacity and digital infrastructure are projected to approach hundreds of billions in 2026. This massive build-out creates durable revenue streams for owners of the infrastructure that supports AI, beyond just the software creators. These are the businesses Wall Street is valuing not for a story, but for income, pricing power, and long-term contracts. In fact, research indicates data center revenue will surpass $600 billion near-term, because every major AI competitor must pay to run their operations on physical infrastructure. Key profit principle: capital doesn't flow to hype forever, it flows into the backbone of growth. Sector 2: Energy and Essential Power Infrastructure. Wall Street allocators are signaling a pragmatic shift toward energy assets that power everything from industrial electrification to digital lifelines. AI and digital infrastructure require massive amounts of energy. The growth rates for electricity demand tied to computing and network expansion are high, and that has turned traditional power generation and grid assets into structural profit machines. Institutional surveys also place energy among the top sectors expected to outperform in 2026. With allocations increasing alongside moves into alternatives like infrastructure. Profit insight: real profits come from fundamental demand drivers, and energy is the source of running modern economies. Sector 3: Healthcare and Defensive Growth Value Plays. Institutions are increasingly allocating toward healthcare as a dual-purpose profit sector. While tech and infrastructure carry growth, healthcare carries valuation support and mean reversion opportunity, especially where the industry trades at a discount relative to broader markets. Fund flows into healthcare and select value sectors are rising because they offer stable earnings with growth, a combination that balances risk during expansion cycles. Profit logic: Wall Street rediscovered that stable profit growth with defensive characteristics can outperform during market rotations. The Natixis Institutional Outlook Survey places IT at the top, followed by healthcare and energy for 2026 expected outperformance, with strong alternative allocations into infrastructure growing alongside traditional equities. These aren't market rumors, these are real allocation trends among large managers. Here is the clear, top-level framework for 2026 profit positioning. 1. Digital and AI infrastructure, where future digital growth generates actual revenue. 2. Energy and essential power infrastructure, the fuel behind growth. 3. Healthcare and defensive growth, stable valuation and payoff. This trisector approach reflects the data-driven allocations of institutional capital, grounded in structural demand, not short-term sentiment. If this was valuable, subscribe for the highest authority in profit strategy content. Comment below which of these sectors you believe will deliver the greatest profit in 2026, backed by data, not hype.